Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading.
We also hear on the dollar versus the euro daily chart from back in 2008, 2009, we had some patterns that formed at the bottom of the chart on our daily chart during this accumulation phase. We have a left shoulder here, we also have a head, and we have a right shoulder here. So we have what we call an inverted head and shoulder, and a break above the neckline is usually a sign for somebody to buy. We also had another breakout above prior resistance here, just a little bit higher up. As the trend moved on, we actually had an ascending triangle pattern form here, which is an accumulation pattern. Sellers would push prices down, but buyers pay higher and higher prices, so that's a sign that the asset is being accumulated once again. We broke out and we actually had another period of sideways trading. A double bottom formed during this little bullish rectangle trading pattern. And so these are some of the patterns, the trend continuation patterns and reversal patterns that formed during this uptrend. We also have on the New Zealand dollar chart, we also have the potential for a new bull flag. We've got our flagpole already, and we're trading inside some kind of a channel on our weekly chart. And once again, if the breakout is to the upside, this pattern could definitely continue onward, and it would become a bullish flag. Of course, there's also the possibility we could break out to the downside here and possibly retest this support area below current price. So you could buy the lower part of the flag here, or if you're somebody that likes to buy strength, you could buy on a breakout above the upper part of the flag up here. And this pattern really reminds me of what the dollar versus the Swiss franc looked like back in 2008. We had almost the identical pattern. We had resistance just above at that time at 108. And the dollar did break out. It did test the lower line of the flag that time, and then it broke out of the top of the flag and went spectacularly higher during that period there, where all the financial institutions in the world were breaking down. We can have some bearish chart patterns form. For example, bear flags, which are trend continuation patterns. Rectangles with breakouts to the downside, or descending triangles. We can have a head and shoulder top. We could also have some double tops. And most of these patterns, again, are signs of distribution, with sellers selling at lower and lower prices. Every time the price rallies, the sellers are willing to sell at lower prices because they're anticipating lower prices from there. So on this particular chart, we actually have a double top. We also have a descending triangle a little bit lower than that. We also have a flagpole and a bearish flag. Each time, sellers selling at lower and lower prices because they're anticipating prices to continue lower at that point in time. So these are bearish chart patterns in a stage 4 decline. And of course, if we have our stage 3 top up here, and we begin to start our stage 4 decline, we're kind of looking for these chart patterns to form because the sellers are in control of the market at that time. So on this particular chart here, which is the dollar versus the Australian dollar, we had a very large descending triangle pattern. We had a period of rectangle trading here with a breakout to the downside, another bear flag. Okay. And now right down here at the bottom, we have another pattern which indicates a little bit of indecision as to which way price is going to go. We have something called a symmetrical triangle. And price could break out. We're making higher lows and lower highs. Price could really break out in any direction. If the breakout is to the downside, it's probably going to find some support around the 105 area. But this happens to be a currency, the dollar versus the Australian dollar, where fundamentally there's a lot of reasons for these patterns forming. Even back in October, we noticed that this particular pair was being shorted heavily against quite a few currencies. Actually, the dollar was what we call the borrow currency in the carry trade. And for some reason, the Japanese yen, which had been the favored currency for the carry trade up to that time, was definitely rallying. So people were more comfortable putting money into Japanese yen during periods of fear than they were putting them into dollars. And so the dollar actually sold off through 2009 and became the borrowing currency in the carry trade against quite a few currencies. Okay, and just remember too, during that period of selling, we had several intermediate term rallies which were counter to the primary trend, which is down in a stage 4 decline. But there were opportunities to trade while this sideways trading was going on. It's just that the Aussie dollar was not one of those currencies that really gave you a lot of opportunity because Australia was very, very strong at the time. And so you can see most of the bearish patterns we had were bearish rectangles with breakouts to the downside. We did have some rallies into trend lines. And so if you're somebody who likes to sell weakness, you could, of course, get short every time price made a new low. But if you're somebody that likes to sell strength on these little counter trend rallies, you could short rallies into these down trend lines. Okay? Provided, once again, you've identified what stage of the market is in, and you're pretty much at that point in time using your trend lines, and we'll talk about using moving averages as another way to make your decisions on which way you want to trade here. Ultimately, though, when the market made this pattern up at the top here, we rallied with a gap, and then we kind of went sideways for a period of time, and finally we declined from there. Once we see this pattern, this again becomes the opposite of the pattern we saw at the bottom of the chart. And this becomes an opportunity, if you're somebody who likes to sell strength, to short a rally in what could be a brand new downtrend. And don't forget, if it's not going to be a new downtrend, then you're going to have a protective stop just above these highs up here, because if price does want to break out and make new highs, then I'm wrong and the market's right. Okay? That's the easiest way to say that. So it's very important that you understand that chart patterns can and do fail, and they fail quite often. Failed chart patterns do lead to strong moves in the opposite direction. Many times, trend continuation patterns will fail when the trend reaches a prior area of support and resistance. And also, the older a trend gets, the more likely the failure of a trend continuation pattern. On this particular chart of the, once again, the dollar versus the euro weekly chart, we have a beautiful descending triangle, but then we break out to the upside. And of course, this becomes a failed descending triangle pattern with a very, very strong rally in the opposite direction. And we just recently, a couple of weeks ago, had a breakout to the upside, and that breakout went right into some old resistance here. And now we're pulling back inside this channel. And there's a possibility that if we break out to the downside here, we could have a brand new descending triangle pattern happening on our weekly chart. Not for sure that's going to happen. We could end up here trading in a channel for a long time going forward. We'll cover a little bit here. We use Fibonacci's, especially in the currency markets. Europe happens to love the Fibonacci's. And the Fibonacci's are great for you to kind of measure cycles by connecting cycle lows from 2008 to the cycle high in 2008. In this uptrend here, we were able to use the Fibonacci tools as kind of like to measure how much of this uptrend we were going to retrace, if or when it was going to resume. Remember, if it comes all the way back down to the bottom of the chart, at this point you would have retraced 100% of the move. And we had that big sell-off, that short covering rally. It was pretty spectacular in December of 2008. And we found support at the 61 Fibonacci and finally rallied up to where we tested the prior highs. And then on the way back down again, a lot of our traders will look to see if there's trading opportunities when price tests support at the 38 Fibonacci or the 50 or the 61. And eventually here, we retraced 76% of this uptrend before we actually found some solid support, and then we resumed our rally.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.